Wonder issued, see, this is the financial instrument part. We'll finish the remaining problems, okay? So Wonder issued $20 million 5% loan notes on 1st January 2009, incurring issue cost of $600,000. The loan notes are redeemable at premium, giving them an effective interest rate of 7%. Again, speaking about this topic, so far, what are the things you can understand from financial statements? We saw, right? Equity at a default measurement is what for equity? What is the default measurement of equity? On which method we will value?
FVPL.
FVPL. Okay. So how about loans, like any convertible notes and all?
Amortized cost.
Exactly. Any loan liability and all, we will value as per amortized cost. Okay. In case, what is the procedure in FVPL? After valuing, what you'll do? Adjusting the market price and all, what you'll do later?
Ma'am, you'll take the two tests, ma'am. You'll take the two tests.
What are the two tests?
Business model test and contractual cash flow. I forgot the last word.
Okay.
Contractual cash flow.
What happened to others? Everybody forgot?
Excuse me, ma'am.
Yes.
Ma'am, I completed.
Okay. Okay, fine. I'll check it. You closed it. Okay, we'll check it. So contractual cash flow test. Okay. So these two tests, if the firm is following, then they can go to which method? Which method they can go?
Ma'am, if they're intending to hold the method, I mean business model.
No. See, if in case you're going to FVOCI, the company should pass through these two things, and then only they can go with FVOCI method. Right? Am I right?
Yes, ma'am.
Yes, ma'am.
And this is not the default method. Default method is FVPL. In case the company want to go with this method, once it is classified or measured as per FVOCI, they cannot change it back. Okay. And we saw some problems in that. So I'll just go here. See, under FVPL, what we'll do, initial recognition, cost of the shares we'll see, and year end, what is the fair value we'll see, and if there is any difference, we will be transferring to profit and loss. Correct? As a gain, we'll transfer to profit and loss. This is under FVPL. If it is FVOCI, we will find out the same procedure only, but if there is any transaction cost, we will add, that is, we will capitalize it. So we will add it with the cost of the share, and then we'll see what is the gain or loss. And if there is a gain, we will take to other comprehensive income. This is the difference between FVOCI and FVPL. Okay, and these are the tests. That is, one is contractual cash flow and another one is business model test. If what is contractual cash flow and business model means, if an entity is holding for more than 1 year, long term they should have the intention to hold the asset in the sense, if you're investing in any company in the form of shares, then you can hold it in the form that asset for a long time. So if you're having that intention, that is business model test. And if it is contractual cash flow means, you have to add principal and interest together, right? Principal and interest together, you should be able to get it back, right? Okay, these are these two methods we saw and few problems we worked out. And now we go on to the next problem, that is problem number 95. So here in problem number 95, first of all, what is it you have to find out? Wonder issued 20 million 5% loan notes. So is that an investment or a liability?
Liability.
Liability, correct.
Liability.
So it is a, yeah, so it is a financial liability. First classification you should do.
Some justification are very obvious, like and your cost, most of the justification.
So this is financial liabilities. And coming to financial liability, when you are checking initial recognition, how will we check it? So here, they said it is a 20 million loan note and 5% loan note on 1st Jan 2009, and they incurred an issue cost of $600,000. So loan notes are redeemed at a premium, giving them an effective interest rate of 7%. So loan note is 7%. They are asking what expense should be recorded in relation to loan notes for the year ended 31st December 2009. Okay, only effective market rate they've given us 7%. So what is how much will be the expense taken to finance cost? What is the finance cost expense? How will you compute it? But something is new here, that is you are having a issue cost of $600,000. What you will do and how?
Transaction cost, no?
Yes.
Capitalize.
No. This is financial liability. Will you capitalize? Is it mentioned anywhere in financial liability? FVOCI? No, right? Yeah.
No, ma'am.
So you have to calculate what is a fair value. That is a fair value or face value, sorry. Fair value or face value, whatever. How much it is 20 million, first of all. So this is $20 million minus how much is the transaction cost? This is like fair value is equal
600,
to selling price minus cost to sell. Can you remember?
yes, ma'am.
NRV, net realizable value or fair value is equal to selling price minus cost to sell. That we have to adopt here. Only for where will we add transaction cost if it is a FVOCI style of investment. If you're making an investment, but this is a liability, you only said that it's a liability. So transaction cost should be subtracted, which is $600,000. I'm subtracting here. And once after subtracting, this is $19,400,000. Right? So here you have to charge. What will you be recorded as an expense? How much will be recorded as an expense? Will it be 5% or 7%? Tell me that. Which will be recorded, which will be computed for finance cost?
7%.
7%.
7%,
Effective
right?
rate of interest.
Yes. So expense in relation to loan or else finance cost is equal to, you have to take this amount. This amount you have to take it. That is $19,400,000 into 7%. How much is it?
$1,358,000.
1,000,003. So much less. Yeah, correct. 1,358,000. So this is my finance cost. Got it? Any doubt in this? This is nothing but the good old formula which we used to say. Fair value. If I'm going to sell, I'll call it as net realizable value. But since I'm holding it, I'm just mentioning fair value is equal to selling price minus cost to sell. So in that, I will always compute 7%. The value of the liability I have to pay is 19,400. Transaction cost should not be included in a liability. Okay, for this liability, I'll be paying 7% as my finance cost. Okay, 1,358,000. Now coming to here, for each of the financial instrument below, match them to the appropriate accounting treatment. Okay, coming to the first one, convertible loans, which is the correct one? Or else we know which is the known one. Equity investments default position.
FAPL.
FEPL. Okay. Then financial liability. Okay, leave. Equity investments where the entity has the intention to hold long term and has chosen to apply the alternative treatment. Alternative treatment means which method?
FVO.
OCI.
FVOCI. Done. Then the remaining two. Convertible loans, which method?
Split accounting.
Split accounting.
Split accounting.
Convertible loans because it has two component, equity and liability. So it is split accounting, and financial liability held for trading is amortized cost. This kind of zigzag and all should not come in the exam. If such type of question is asked, you have to write number one, convertible loan notes. I should not tell that, but still in the ACCA paper, you'll have a matching, so you can do it. But here you'll be writing in paper, no zigzag positions and all. Convertible loan notes, you have to immediately write split accounting. Like this, I expect the question. If in case you're answering, you have to answer like this. Then number two, if it is equity investment complete, then you have to write, and then you should write fair value. This also complete form, OCI. You have to write it completely like this. You have to take it and write it. Don't put all the zigzag and submit it. Okay, now we go on to the last set of the question for this chapter. This unit, actually, I can tell this unit is ending now, and we'll discuss something about the unit also. The following scenario relates to questions 291 to 295. The following trial balance extracts relates to Howard at so and so. Okay, fine. This is a scenario based question. No point in reading right now. We can go to the straight away to the question, and then we can read whatever is required. Which of the items included in the trial balance extract will be classified as financial instrument? They've given you the option. Which and all will be coming under financial instruments. Convertible loan notes and equity investments only. Is it correct? Only convertible and equity investments we have. Don't we have other things to classify under financial instrument?
Yes, ma'am.
We have financial liabilities also. Okay, then second one, loan notes and equity investment only. Convertible loan is also a financial instrument. Okay, then here convertible loan notes and loan notes only. Only the loan part they are taking. What happened to the equity part? What happened to the investment part? Nothing is taken. So which will be the correct answer?
All three.
All three items. Actually, I'm hearing a different voice. Who's that? Someone is answering. Is that? It's you. You answer no always.
Yes, ma'am.
Okay, then 292. What should the value of the liability element of the convertible loan notes be at 30th September 2005 to the nearest thousand? What should the value of the element of the convertible loan note to be at 30th September 2005? For this, we have to refer the question. Without that, we cannot do. So they are speaking something about the convertible loan. Let's go to the question here. See, this is a question. The first paragraph speaks about convertible loans. So what is given here? The convertible loan notes are 8%, 30 million convertible loan notes issued on 1st October 2004 at par. An equivalent loan without the conversion would carry an interest rate of 10%. What do you mean by this 10%? What is this called as?
Finance cost.
Market rate, right? I can call it as market. You're correct. You have to compute this for finance cost. But this is the effective market rate. Normally we call it as, okay. Then Howard's finance director correctly split the instrument into its equity and liability components at 1st October 2004, but has done nothing else. So you are expected to do. That is what should be the value of liability element. You have to find the value of liability element. So liability element, how will I find it? Which method I should go with?
Present values.
Okay, that is amortized cost. That method is called as amortized cost. And we'll be finding out what is the liability quotient. And once liability is done, you have to deduct it from the entire amount so that you can find out what is the equity quotient. See, convertible loan notes are issued at 8%, 30 million convertible loans issued at 1st October 2004 at par. Can you see some other convertible loan in the liability, that is trial balance? How much it is mentioned? Is it 30 million here?
I think the 18 maybe 9
Yes.
No, ma'am.
Yeah. What is this? 28,508. What do you mean by that?
That means the equity quotient is remaining.
Equity quotient? I didn't get you. What is the equity in this? Is it 28,508 is equity or 30 minus 28.5?
No, 30 minus 28,508.
Okay, so 28,508. This amount is what? This is purely amortized. You have to amortize it. This is a financial liability of it. Okay, what is the question here? They are asking what should be the value of the liability element? Only the liability element they are asking. They are not asking about the equity quotient. What is the value of the liability element of the convertible loan note be at 30th September 2005 at the end of the year? So I have to pick not this 30 million, that to take 28,508 because that is the liability component. Remaining is an equity component. Okay. So that 28,508 I will take it and then I'll be finding out the amortized cost, that is market effective rate I'll be finding out and minus interest rate. So let me take you to the PowerPoint once again here. See the formula once again. Yes, this is. I've underlined here. Can you see this formula? This formula we'll be using. Okay, initial value plus market value minus interest paid, because end of the year they are asking. End of the year means subsequent measurement. So subsequent measurement, how will be recorded? Initial value. So the value of the equity is loan is 28,508 plus effective interest rate, that is 10. What is the effective interest rate in this problem? It is actually 10% is the effective interest rate. So you have to find 10% of 28,508. Then minus what are you actually paying? You're paying 8%. So this you have to subtract and then find it out. So let me go one after the other. So I'm going to find out, this is question number 292, right? Yes, 292. So I'm going to find out what is the amortized cost. So coming to the amortized cost is given here. Initial value plus effective interest minus interest paid or amount paid, whatever. So coming to initial value, how much is the initial value? This is a one line item, no need to, if we are doing for 2-3 years, then we have to put a table and do it. This is only 1 year, so finish it. So this is 28,508 plus effective rate of 10% of 28,508. So it is 28,508 into 10% minus interest. How much interest are you paying every year?
8%.
8%.
8% of what?
30 million.
Very good, very good. So 8% of 30 million you have to take. Since always I've removed 3 zeros, I'm taking only 30,000 here. 30,000 into 8%. Okay, so this is 28,508 plus 10% will be 28,000, sorry, 285, 1. 2851 I'll put, because 2850.1 it'll 0.8 will come. So 2851 minus 8 3s are 24. So 2,400. So if you do this, that will be the value. 28,508. Sorry. Plus 2851 minus 2400. So 28,959. It's the answer. 28,959. So let us see which is the answer. Could you understand this? Let us check the answer later. Could you understand this part?
Ma'am, I didn't get why we took 28,508 now.
Effective interest. See, wait, I'll go here again. So, so can you remember this problem? Once you people listen to this, compound instrument, convert company issues a convertible loan that pays 2% per annum in arrears. The market rate is 8%, being the interest rate of an equivalent debt without the conversion option. The loan is 5 million is repayable in full after 3 years or convertible to equity. Discount factors as follows they've given. Split the loan between debt and equity at inception and calculate the finance charge for each year until conversion or redemption. Just a minute. One minute. Okay. So this is in this question, if you see, they didn't tell you how much is the liability component. They just told you that the company is issuing convertible loans, which pays 2% interest and 8% market rate of interest, and the loan is 5%. They didn't tell you how much is the equity, how much is the liability component, but they told you what is the discounting factor. So if you see again, if you go to the slide, here, liability is measured at its fair value. Fair value means what? Present value of future cash flows, that is interest plus capital, discounted at market rate of interest. Okay, so present value of future cash flow is interest plus capital. We go back to this problem once again because you have to understand what we are doing. No point in rushing fast. So cash flow is a problem. No, yeah. See, the loan is 5 million and interest is 2%. We have taken initial cash flow as 100, means to say 5 million into 2% is 100. That is your interest. First time you will be paying interest of 100. Second year you will be paying interest of 100. Third year you will be paying 5 million also together. 5 million 100, 5.1. If you do the discount factor, the value is coming to 4,288 only, but your loan is 5,000. So how much is the equity component? This 5,000 minus 4,228, that is 772 is the equity component. In this particular problem, what we are solving, they gave loan received also 30 million, if you remember, and they've given how much is the liability also, that is 28,508. Yes, the person who asked, can you understand?
Yes, ma'am.
They've given both. So this entire 5,000 we will not take anywhere. We will take only 4,228 and then we'll be finding out what is the effective market rate and how much you're paying, then balance carry forward. But in this particular problem, only 1 year they've asked, so I didn't put this table. I straight away took the formula. See, you must know to do it shortly also, right? So I just straight away took that formula. See, I didn't take 30,000 anywhere because 30,000 includes equity component also. Amira, can you follow?
Ma'am.
Okay.
Yes, ma'am.
So let us see what's the answer here. Any other doubt you people have in this particular problem? Okay, so let me go here, 292. What should be the value of liability element? So I got the answer of 28,959. The same answer is here. It's appearing in C. C is the correct answer. Then come to 293. What finance cost should be shown in the statement of profit or loss in respect of the loan notes? How much will be shown as a finance cost? 2,400 or 2,851? Oh, 1 minute, 1 minute. Not convertible loans. What they asked here? What finance cost should be shown in the statement of in respect of loan? I think some other question is here. Yes, we have finished this convertible loan. This is done. Now 5% loan they are asking. 293. See, the 5% loan notes were issued at a par of 10 million, but Howard incurred 4 lakhs issue $400,000 issue cost. The loan notes have an effective interest rate of 8%. Just now we did one problem like this. So what should be done here? 293. How will we compute?
10 minus 400, 10 million minus 400,000.
And the remaining will be? Okay, with the remaining, what I should do? I don't want what is the remaining and all. Just tell me what should be done afterwards to find out finance cost.
Finance cost, ma'am, with the remaining we should do 8%.
8% of it. Okay. So here we are finding out what is the fair value. Means to say I'm going to find the loan notes value of loan notes or whatever. Loan notes. Okay. I'll just write loan notes. Loan notes 10 million. Say this is not matter actually. What you write here. Okay. Loan notes is 10 million minus issue cost. What is given in the book itself? I'm just picking. Issue cost, sorry. Issue cost is given as 400,000. This, if I subtract, I'll be getting $9,600,000. Fine. So I have to find what is my finance cost. Finance cost is equal to $9,600,000 into 8%. Right? Any doubt?
Yes, ma'am.
Computation, multiplication and all you're learning from childhood. That is not a problem. You have a calculator very much. So $7,768,000. So this is $768,000. So I've taken the 10 million. Let's see the answer. It's 293. $768,000. Just have a check. I have some doubt in the zeros. I solved it wrongly here in my note. Okay. So it is 9,600,000 into 8%. Yeah. I put 2 zeros extra. Okay. Okay. 768,000. Okay, done. Now we come to 294. What is 294? Yes.
Ma'am, can you just scroll up?
Hmm.
Thank
Still
you.
more?
Done.
Okay. So 294. What income should be recorded in the statement of profit or loss in relation to the equity investment? Now they are asking about equity investment. Let's see anything about equity investment is given. Yes, something is given in question number 3. So this is done. The equity investment relates to 1 million shares in Kapoor, an unrelated entity. During the year, Kapoor paid a dividend of, so this is an investment. Okay, you make an investment there. You don't have any other stake. That's why they mention very clearly it is an unrelated entity. Okay, so Kapoor paid a dividend of 10 cents per share. At 30th September 2005, the fair value of each Kapoor share was $7. So now what is the question here? What income should be recorded in the SOPL in relation to equity investment? How will you record the equity investment? What and all are possible in the equity investment here? Tell me out of equity investment, what and all you're earning. I'm going to highlight in a different color. Tell me what and all are possible in equity investment. What are the possible income you're earning from equity investment?
Dividend.
Very good. Dividend you're earning 10% per share. Then what other calculation in general when what we'll do for equity investment? Any equity means what we have to find out. Yes. Something else is given in the problem. Can you see where else equity is there?
Up, ma'am, 6,000.
6,000 means 6 million actually, right? Your equity investment in the book value is 6 million. Now what is the value of the share?
7
So
million.
because 7, now it is 7 million because you invested 1 million share, but in the balance in the table it is shown it is 6 million means In the record, it is recorded as 6 million, but now presently the shares are traded at $7 per share. So what is happening? What happened?
Income, ma'am.
We call it as income or revaluation gain?
Revaluation.
Revaluation gain. Okay, they didn't mention anything, means we will go with FVPL method. So let us go. It is 10 cents per share, and how many shares they are holding? It is given here 1 million shares are held. So 1 million shares are held means, so I should start as 294. So first, I'm going to find out what is the total income. That is my intention. Whether it is realized or not realized doesn't matter here. You have to find out. So first, I'm going to find out how much is the dividend income. Dividend, I have 1 million shares and 10 cents. 10 cents means, how will I note it down?
0.1. $1.
0.10, which is equal to $1. Sorry, $100,000. Done. Now I have to find out what is the revaluation gain. Should we have to go to the format and all? It is not required. They just ask what is the total income. So what is the revaluation gain? How was the what is the initial value of those shares? What is the value of those shares?
6 million.
6 million. Now it is.
7 million.
So how much is the gain, revaluation gain? So revaluation gain is the difference between those. So 1 million is the difference. So it is $1,100,000. So this is the total income. So let's see whether we have the answer. Yes, B is the correct answer. Then the last question.
Ma'am,
Yes.
ma'am, 1 minute. I couldn't get from where this 6 million came in.
See the question. Can you see this is your extract, trial balance extract, right? So in that it is given convertible loan notes is 28,508 and 5 million, 5% loan notes, 10,000. And then you have an equity investment of 6,000. And for that equity investment, they said note number 3. What is note number 3? Equity investment relate to 1 million shares. So 1 million shares, but it is mentioned as 6 million rupees means one share is 6 rupees, $6. Correct.
Yes, ma'am.
And now the fair value is per share, it is $7. Means to say $1 increased per share. So 1 million increased. So 1 million is my revaluation gain. Understood, Elizabeth?
Yes, ma'am. Thank you, ma'am.
Okay. Now we go to the last question of this unit itself. 295. Howard is uncertain of how to treat professional fees. For which of the following investment should professional fees be capitalized as part of initial value of asset? Yeah, tell me where I should capitalize professional fee. Professional fee is what?
Transaction cost.
Transaction cost. Where I have to do it?
In FVPL.
FVOCI.
FVOCI, we will do it. And anywhere else? FVPL, no, not at all. Amortized cost of investment, will we capitalize? We will deduct to find the finance cost, but will we capitalize amortized cost of investment?
I don't think so.
This actually, I have a doubt in this. See, We cannot blindly follow the study text or not the study text, exam kit. If there is, I'll just open exam kit here. We'll see what is the answer for that. This is 295. No, let's see. This is the problem. Okay. Yes, they have capitalized, amortized cost investment capitalized. Okay, let's see here. Anywhere it is mentioned about transaction cost. But we didn't do any problem in that, right? We didn't capitalize in any of the projects. We capitalize anywhere in amortized cost.
In investments we did, ma'am, not in liability.
Of course. So, but they didn't tell whether it is what type of instrument. No, of course, in convertible instruments we'll do it, but not in amortized cost. But oh, investment is mentioned. No? Yes. So it is capitalized. It is amortized cost investment. Can you see this?
Yes, ma'am.
So it is capitalized. Fine, fine, good. Okay. Let us go to the last slide here. Something we need to read. It's a theory part, okay? Derecognition of financial instrument, because IFRS 9 covers the measurement aspect only. So financial assets, when and only when the contractual rights to the cash flow from the financial asset expires. That is either if you completely withdrawn it, you received the money and you sold the share and all, obviously it will be derecognized from the financial statement. Okay, you will derecognized. Okay, then financial liability also, when and only when the obligation you actually paid it, okay, you settled it, then the financial liability also will be derecognized from the business. Carrying amount of asset or liability, if the amount received or paid, it should be shown in the SOPL. Okay, if you are completely settling that, you have to expense it out. Okay, this is the style of derecognition. And coming to the factoring of receivables. Okay, what is factoring? First of all, this is one new term, this only theory part. Okay, you have only theory in this. Factoring of receivables. If a company, for example, this receivables is a very, very important part. That is collecting the money from the people who should pay you. It's very, very difficult to collect. So some of the companies will give it to some agency or other organization to take care of receiving the money from the receivables. Okay, so a company transfers its receivable balances to another organization for management and collection and receives in an advance on the value of those receivables in return. That is, you take care all, for example, bills receivable. You know the concept of discounting, right? Discounting of bills receivable from the bank. Yes or no? Are you people aware
Yes,
of
ma'am.
it? Aware of
Yes,
it,
ma'am.
right? Okay, you will take your bill, go and discount from the bank, but the bank, that money of bills receivable, let us assume, will be paid only after 3 months, but the bank will give you money immediately and take the bill, but they will give at a reduced cost. For example, $10,000 you have to receive from your receivables, but you are in need of money. What you will do, you go and give it to the bank, the 10,000 worth of bill to them, but the bank will give you only $9,500. Means to say 500 is my discount charge. Fine. So this concept, the same thing, if you're giving it to another organization and taking the money in advance, that relationship, we call it as factor relationship. Okay, this is called as factoring. Okay, under factoring, who bears the risk of slow payment and irrecoverable debts? Who will bear it? So two are there, with recourse, without recourse. What I'll do is this one point I'll cover in the next class because it's 9:50. You have a CBCS class now, right? I don't want to rush up here.